welcome to today's webinar. My name is Sean van den Berg. I'm investment specialist at PSG Wealth. We've done the sound check, and you guys know where to put the questions if you have any questions that you might have. And I will be, I am recording this presentation, so we send out to you guys so you can review it as well as the PDF of the presentation. As you can see, today's webinar is entitled "Markets Can Stay Irrational Longer Than We May Anticipate." So the first question you want to ask yourself, who is the market? And the market basically is the people, and the people is made up of investors and traders, or buyers and sellers. So that's first of all the market. And secondly, you must ask yourself, what does it mean by irrational? Irrational means not logical or reasonable. So the reason for this webinar is irrational behavior is one of the most difficult behaviors to deal with. And when someone is being irrational, they don't listen to reason, logic, or even common sense. So saying that is until that need is fulfilled, or they snap out of it, the irrational person can be unpredictable and sometimes even dangerous. Okay, so the reason I'm saying that is we've seen the volatility on the market, we've seen the market uncertainty, which leads to obviously market volatility, and investors need to be aware of the potential risks during times of volatility. Choosing to stay invested can be a great option if you're confident in your strategy. So saying that, we've seen the last few weeks that shares on the JSE have fallen to what I call bargain level prices, as investors obviously struggle to assess the impact of this COVID-19 coronavirus that will have an impact on global as well as obviously the South African economy. So there's talk that a recession looks increasingly likely, although it is not clear how deep or how long lasting it may be if it happens. The bottom line is that we have a period where there's a lot of volatility in the capital markets, and that's part and parcel of investing. So unless something has materially changed from an investment objective standpoint, there should be little need to switch between investment products as a result of the short-term market performance or in and out of investments based on market moves. And I've seen this the last 2-3 weeks where suddenly everybody wants to have a share trading account and suddenly everybody wants to buy shares. They've never traded before, they think it's opportunity. And this is the reason for this webinar today, is just to talk about that, everybody jumping in and trying to take opportunities. Okay, so here's my agenda, what we're going to discuss today. If I can just get to the next slide. Whoops. Okay. Wow. I haven't had so many people on a webinar for a long time. Awesome. Okay. So here's the agenda as such. We're going to discuss 3 little points quickly in the next half an hour. Human emotion is investors' biggest enemy. What is your strategy? And be cautious and always do your research. Those are the main 3 points I want to get across today. So to get started, we talk about emotion. Human emotion is the biggest enemy in the market. When we talk about human emotion, we're referring to the 2 biggest ones, is obviously greed and fear. So it's everybody has it. Everybody has human emotion, and you'll come across it during your journey as an investor also. But the harsh reality is something that we need to accept, human emotion. But it's more important to learn how to deal with human emotion, especially when it comes to investing and obviously when it comes to money. So every investor is different. We have different mindsets. We have different investment styles and different tolerance, when it comes to allowing our emotions to get to us. So my objective today is to briefly discuss how our emotions can sometimes get the best of us while investing, number 1, and number 2, to find ways to get past it and use it as by using a positive mindset and letting the past be the past while choosing or focusing on the future. Okay, so here's a quick, just some quotes quickly regarding human emotion. The whole idea is a struggle between logic and emotion. So we've all heard of Warren Buffett, the #1 investor in the world, and this is one of his most famous quotes: "Be fearful when others are greedy, and be greedy when others are fearful." And that's what we see now. A lot of people have got into the market the last few weeks because of the amazing opportunity in the market. The JSE has had a massive big sale, but I think to a large extent, a lot of people have been greedy. It's going to make a quick buck, and they're chasing the shares and things like that. But we'll talk about that a bit later. Here's a quote from Daniel Kahneman. It says, the more emotional an event is, the less sensible people are. Okay, and then thirdly, I think Bill Kramer, some of you might not know who's Bill Kramer. He's a American television personality. He's also a past hedge fund manager and also a best-selling author. Jim Cramer. Jim Cramer says that bears make money, bulls make money, and pigs get slaughtered. That's when it comes to being too greedy. Okay, so have some water here. So let's talk about emotions. And I refer to what I call the roller coaster of human emotions. So remember, our goal as investors is to get high returns with minimum risk. So yeah, you can see the roller coaster. We all like to buy when we're optimistic. We feel optimistic. Things are going our way. You can see as the market goes up higher and higher. Let me just bring my cursor in here. In my little spotlight. And as the market goes up higher and higher, obviously we have more emotions. We feel excitement, we feel thrill. Around top of the market, euphoria. You know, there's a saying in the market, old saying, that buy a share today and have a push tomorrow. That's where the markets are going through the roof and everybody's in the market. And then we have things turning a bit, and then we have this roller coaster down. And then anxiety kicks in, and denial, and fear, desperation. And this is where, at the top of the market, and I always say this is where the hairdresser gets involved, and the bottom of the market is where the hairdresser sells. So you find that the market, as it's dropping, we have this roller coaster of emotions, panic. We see this the last few weeks in the market. And then capitulation. This is where capitulation is basically meaning you're giving up. You're not fighting or you're not resisting anymore. You give up. And then we hit the area of respondency, depression, and then this is the area of maximum opportunity. So are we there right now? This is a question you need to ask yourself. I see that there is the market is starting to bounce back, so there is maybe hope, and I hope we will see more relief. But there's so much uncertainty still in the market, and that uncertainty will still lead to a lot of volatility. I saw this morning that Sasol was up 20%, and last I saw it was down 20%, 21%. So that's the kind of volatility we're talking about. Okay, the bottom line is that yes, maximum risk. You must understand when you're buying at the top of the market, you must understand high prices, the prices will come back at the bottom of the market. You're buying the maximum opportunity, provided, and this is the whole underlying idea of this presentation, provided you buy good quality companies with solid balance sheets, companies that will be resilient. It will be able to handle that. It's got no more manageable debt, rather sitting on a lot of cash. Those are the companies that you want to be investing in. But we'll talk about it a bit later. Let's move on. So let's talk about let's talk about volatility. So some of you might have heard of this indicator called it's more commonly referred to as a VIX index, but it's also called the fear index. You'll notice these two big spikes. Most recently, I took a snapshot on Monday, and you can see when there's the last, it was there way back in 2008. So our last big spike was way back in 2008, our last crisis. So what we just seen now recently is obviously a big spike on the VIX index. So it's just an indicator, what they refer to as the fear index, but basically this indicator refers to the expectation of volatility on the market, and this is mainly expectation of volatility in the options market. So that's CBOE, as it's the Chicago Board of Options Exchange. Okay, suppose what are we looking at here? High VIX readings means investors see significant risk that the market will move sharply. And remember, as I said, that spike was maybe last week, so this, you can see I pulled back by Monday, that was by the 6th, where the investors were taking out a lot of insurance, taking out put options and things like that. So basically that's what's highlighting for you. So it works inverse to the share market. When the market goes down, investors would want to purchase more insurance, take out more options as such, and obviously that will drive the prices up on the put options and obviously increase the the VIX. When the VIX decreases, there's less demand for put options or insurance, and the market obviously rises. That's why they move inversely. So that is one thing that you want to keep an eye on. You can always go Google that, the VIX index. Another one I came across was quite interesting is the Fear and Greed Index. This is from CNN Money, their website. This is again a snapshot. This was on Monday. You can see my date here. Last updated on Monday the 6 o'clock. On Monday the 6th. But it basically it's you can see it's bounced back a bit now. We're back to 32. That'd be neutral. A year ago, we were extremely greedy. Okay. A month ago, we were extremely fearful. Okay. And then slowly this has been coming back. Okay. That's where we are now. What it is, as I say, it's a gauge of what they call investor sentiment. It's built on 7 indicators, measuring investor sentiment, things like safe haven demand, put and call options, the difference between the two of them, look at market volatility, looks at share price, the breadth, how many shares going up, how many shares going down, as well as obviously share price strength, as well as things like market momentum and junk bond demand. Those are some of the criteria. But I suggest, as you can see at the bottom here is my source there, CN Money, just an indicator for you to look at the volatility in the market and as a gauge for you as an investor. Okay, so how do you avoid making emotional decisions on the market? Yes, it can be part of the game. So your goal as an investor is to become objective. So yes, on the one side of the scale, you've got greed, the other side of the scale, you've got fear. You want to position yourself right in the middle, be objective. So how do you do that? You create systems and rules that you put in place that help you avoid making emotional decisions. So first of all, I believe that you should have a long-term investment strategy. Okay, that's very important. Number 2, find a balanced approach between being overconfident and being underconfident. So as that balance, so it's just basically having the confidence in your investment decisions. Be completely diversified. And I've seen so many people the last 2-3 weeks put all their money into one share. Okay, it's like playing roulette, putting your number on black, or putting your number on red. So yes, that has played in their favor, but there's so much volatility and so much risk in that strategy. You want to build up a diversified, balanced portfolio. Okay, and this point number 4, do not be afraid to lose. A lot of people play, in sport, they have the saying, the team is playing to win. But you also get to the stage where the team is playing to avoid losing. So that's very conservative and playing defensive. Sometimes it works, sometimes it doesn't. Okay, so this is what I mean by that. Do not be afraid to lose. So it's taking calculated risks. And now we're going to do calculated risks by doing our homework, doing our research on companies and things like that, doing the fundamentals and doing the technicals, being the odds in your favor. That's what I mean by that. And then we get swayed by information, by news. Okay, we read something in the newspaper, we get something on social media, and then we have a knee-jerk reaction. Do not make decisions based on that kind of information. There's only time, we'll talk about it again just now, but there's only 2 real times that you want to really be watching the news and things like that. The time when you want to buy and the time when you want to sell. The rest of the time, you're looking at the fundamentals of the company. And then also, do not be a sheep and follow the herd. Now, Warren Buffett says just now, he said, be fearful when everyone else is greedy, and be greedy when everyone else is fearful. Be a contrarian investor. When everyone else is selling, you want to be buying, and when everyone else is buying, you want to be selling. Okay, so don't just be a sheep and follow the herd. Be the contrarian. Okay, be that outlier, as Malcolm Gladwell would say. Okay, so that's just some quick tips. Help you on that. Let's move on. So this is a snapshot. This is the JC All Share. This gives you the weekly chart going back about 5 years. You can see how the market fell back, how the market came back or corrected. Okay, and then since then we've had a little rally. Okay, market, but we're still this is the MACD indicator. We are still very, very, very oversold. This is the lowest been in more than 5 years. Okay, so there's still opportunities. Again, this is until Monday's graphs. So since then, the market has raised a bit, but we're still way below our little moving averages there. So the trend is still bearish. Okay, so that gives you some insight there. And then if you look at what's happening on the markets generally, this is again the snapshot until I think it was Monday. the different sectors for the last year. First of all, the last 3 months since this whole coronavirus started, you can see the biggest movers negative would have been basic resources. Okay, that's 21%. And then financials, they have been hit hard. 36%, that's the last 3 months, and this is 6 months, and that is the last year. But also the other side of the coin, you can see the gold market, the gold mining stocks, they've been running for the last 6 months, positive 42, and for the year so far, 118. Okay, you'll see another slide just now where some of those gold mining stocks come up. So that's looking at local stocks. Okay, so I've only highlighted in red things more than 20%. Anything more than 20% has always been classified as a crash. So you can see we're basically in the bear market. Okay, a lot of those companies, and some of them we are still coming back to it. You know, we're only like 2% off on the Aussie. Okay. This is looking at the international markets, the Dow Jones, the last 3 months, more than 20%. The FTSE, the London Stock Exchange, 25%. The world index, by the way, is down 20%. So world markets, we're in a bear market. Okay, Frankfurt, they've been in the bear market since, well, for a long time. Okay, so you can see there. I've just highlighted, as I say, everything is red. Not many positives there, not many positive markets. Okay, I don't know. What I did is I did a scan of the only using the top 100 shares since February, so the last 2-3 months. Okay, obviously out of the top 100, you can see that 80 of them were negative, with Sasol obviously the biggest faller. This is again until the 7th, which was yesterday. Okay, so you can see, well, that'll be Monday's data. So Sasol was down 80% so far. Sohosan was down 78%, and you see a lot of the property companies, a lot of the rates are down. But you can see right back here, right into Money PLC, they were down 84%. And then I also did another scan. By the way, the criteria was anything less than 0% loss. Okay, and I did the opposite. Anything more than positive or zero would have been positive. You can see Azor, we know what's happening with Azor, they're going private. But look at Anglo Gold, Sibanye, Goldfields, 3 gold shares, the shares that are positive. What's interesting to note also, there's your clicks and your shop rights. Okay, then nice passes, and then bats. This is not the bats that caused the coronavirus. These are this is Benchmark and tobacco. Very defensive. We said that bats is defensive. And then Vodacom, Pioneer Foods, and Tranquil. Okay, so interesting things to look at there. So let's move on to what is your strategy as a long-term investor. So the big difference between being an investor and being a speculator. The big thing about being an investor is that you do your homework. You're not going to go, you're not in for the short term. But also what's important is your risk tolerance. So I find that a lot of people jump into the market right now. They haven't even thought about these things yet. Okay, so there's a scale here between risk and reward as a trade-off. As we move up to higher rewards, we would expect to have higher risk. They should work in tandem. So first of all, the first category you get is those investors that are very conservative. They expect a low reward, low risk. These are people that just want to preserve the capital. The share market is not for you. You should be putting your money in the post office or in the money market account. Okay. If you move up the scale, this is where you should be what you call a prudent investor or prudent trader. I talk to both groups now. Being a prudent, someone who's wise, you want to go for high rewards at lower risk. So remember, yes, there's still risk involved, just managing that risk. Okay. Then we move to the other side of the scale, where we get, you can see also he's looking at the gap, he's analyzing it, he's calculating the risk and things like that. That's what this little image highlights here. Yeah, the image here is umbrella protection. Yeah, we got someone on the tightrope, as aggressive investor or trader. You want to go for high rewards and high risk, but it's a balancing act. You can see you can go any which way. To me, this is the cowboys. Okay, so this is where you want to be. High reward with lower risk. How you do that? You do your homework by betting the odds in your favor. And in the last category, this is where you should not be being. I call it speculative, but you can see the guys on the roulette table, the poker table there. This is the gambler. This is someone who's going for low rewards at high risk. Okay, you should not be being in that situation. And this is where I find a lot of people are right now. Okay. So saying that, talking about investors being trader, what are you? Are you investor or trader? A lot of people don't even know that. It's a different strategy. So I've broken this up, and some of you that have been on my webinars before, this is the easiest way for me to explain the two is by looking at the time horizon. The main difference is your time horizon. Investor has a time horizon more than 3 years. A trader has anything less than 3 years, just the opposite. The reason why I say that is because of the tax implications. Very important to take that in consideration. Basically, as an investor, your style of managing your portfolio is more passive. You're going to be buying and holding. That's a buy and hold strategy. But basically, you're focusing on managing risk. And we do that by diversifying our portfolio across a few sectors and across a few different shares. That's the main emphasis of a passive investor. So you'd be focusing more on fundamental analysis, looking at the numbers, but you want to find value in the market. You're a bargain hunter. That's one style of investing, being a value investor. You can be a growth investor, and you can also be investing for dividends. But your main objective is for capital growth and dividend income. If I buy once and I never sell, I have low brokerage costs. And again, if I buy the share and after 3 years decide to sell, then capital gains tax applies. Okay, your first 40,000 of profit is exempt from tax, and then works on they call inclusion rate, 41% of your marginal tax rate. The most you're going to pay on capital gains, which is 18%, which is much lower than income tax. Okay, so that's very important to decide what you're going to be. You decide what your portfolio is going to be. You can't just say these shares are investing and these shares are for trading. You say to the receiver every year, so this is my capital portfolio, this is my trading portfolio or income portfolio. And then everybody gets affected by dividend withholding tax. If dividends are declared, they will take 20% off before paying you the dividend. Okay, so that's the investor. Quickly on the trading side, it's more active management. So first of all, understand being an investor, being a trader takes more time. You have to be watching the market. Basically, buying and selling. You want to be taking advantage of volatility. But how do you take advantage of volatility? It's by managing risk also. Okay, so we talk about position sizing, and we talk about stop loss and things like that. Okay, so if you're looking at more of the charts, so using your technical analysis, so you're focusing on price action, your goal is capital growth. We heard it saying before, buy low, sell high. Okay, that's what your objective is. And if I'm buying and selling, you understand that you will have higher brokerage costs. And as I said just now, any profit you make, you have to add that profit as income onto your income statement, into your income tax at the end of the year. Okay, so that's very, very broadly the difference between the two of them. Decide your strategy. Okay, are you investor or are you a trader? There's different styles also within these investing and trading styles. But first of all, decide on that. So be cautious and always do your research. So when it comes to value investing, this is what a lot of people are looking for. They're bargain hunters, very much like the Warren Buffett of the world. He's a value investor, he's a bargain hunter. He has general guidelines. So you want to buy the business, not the share. Okay, very big difference here. Buy the business because you're long-term thinking. So that ties into point number 2. Love the business you buy. Understand what you're buying. Do due diligence on the company. Don't just go buy the share because you're looking at the price. Warren Buffett has another saying: price is what you pay and value is what you get. Okay, so 500 Rand share can be cheap relative to its profits or earnings, and a 50-cent share can be expensive relative to its profits and that. But also understand what you're buying, and that also leads to number 3. Simple is best. The less complicated the business, the easier. If you can understand the business, and you can be able to come up with a general idea what the business does and the earnings and the growth forecast and things like that. That's the kind of business you want to be in. The more complicated it is, you're going to be confused. Okay, you're buying into companies where the managers or the management or the directors have a big ownership in the company. So look for owners, not managers, because management is very, very important, especially now, what we're going to go through now with the next few weeks on the markets. When you find a good share, buy a lot. Okay, so you analyze a company, buy as much as you can afford in your portfolio. Remember, you want to still structure your portfolio along the lines of portfolio management. You don't want to allocate too much funds to one share. So it's developing that portfolio along that. And then also, measure the share against your best investment. If you've got 5 good quality companies before buying this company, how does it measure to the shares in your existing portfolio? Remember, you want to buy a share, you're going to add a share to your winning portfolio because you believe that's got a winning potential. Okay. And as I said just now, ignore the market 99% of the time. You gotta watch the market when you want to buy, and you want to watch the market when you sell. Other times, you want to be looking at the fundamentals of the company and finding out if anything changed on that. Okay, that's just quickly, very broadly, some guidelines to help you get started. Okay, so on our website, and this is what I want to highlight to you, be a good researcher. Those of you on my webinar in February, we spoke about being a good share investor. So please go back to that webinar. There's a lot of information in there, but regarding being a good researcher. But on our website, on the P3 Wealth website, there's a research hub. And in the research hub, there's a tab called recommendations. And it's all highlighted for you, our top 10. This is a starting point. What I want to highlight for you today is undervalued quality shares. And one of the shares in there is a company called Old Mutual. We all know Old Mutual. Okay, so if you click on the little link, Old Mutual takes you to what they call the share info page. And part of the share info page, you'll be able to pick up the company analysis or the investment idea. So this was done now 2-3 days ago, sorry, a week or so ago, on Old Mutual. So if you can click on there, it gives you some more information about, or videos about our past investment ideas. But what I like about Old Mutual, sorry, let me just get some water again. Okay, so some of you might know that Old Mutual had a separation recently, got a divorce. They split Old Mutual Limited and Quilter PLC. Old Mutual right now contains the emerging market operations as well as 19% of Nedbank. And Quilter is the wealth business in the UK. So that's what's been happening with Old Mutual recently. But what I want to highlight to you guys is this little thing here. We've been talking about confidence, and this is a very simple triangle that highlights three criteria: value, quality, and confidence. And you'll see this little black line. If I bring my cursor back in here, is that this little triangle, black triangle, should be as perfect as possible. You can see it's very close to being perfect. It's meeting value there. It's coming to the quality side, and it's confidence. Okay, but this is a very important little thing to look at, and I want to highlight this there: confidence. They did the fundamental research guys at PSG Wealth did a whole thing about the past recommendations. And the companies with high confidence, it's a scale they highlight. High confidence levels are companies that have fared better. Yes, most of the, as you saw just now, most of the shares have fallen, but these are the companies with high confidence that have fallen the least. Companies that have low confidence are the ones that fall in the most. Okay, so when you're doing your homework on a company, or doing research on companies, when we look at confidence, there's the quality, there's a lot of criteria we look at. I don't go into it right now. What I suggest you do is go click on this little link here, takes you to a video that we did quite a while ago that explains this triangle and what we're looking for when we talk about value and quality and confidence, especially confidence factor. That's what I want to highlight in this presentation today. We're looking at the confidence factor. Okay, so guys, I have to speed up a bit. I'm running out of time here. Okay, so whoops. So if you go onto our website and you go to what they call filters, you can go select different sectors on the market. So I went and looked at the life insurance sector, and it brought up all the players in that group. So we got Discovery, we got Clientele, we got Liberty Holdings, Sanlam, and Old Mutual. Now, as I said, I want to highlight Old Mutual for you because number one, we feel that the current downside risk from the spread of COVID-19 is a significant headwind for everybody, and obviously it will have a big impact on the insurance industry as a whole. But we believe that because of Old Mutual's size, number one, number two, the balance sheet strength, as well as the low discounted group equity value, This will present an opportunity in the sense that it'll be more resilient to economic challenges in the year ahead and offer better potential for upside relative to its peers. That's number one. And number two, what's important is that we feel that because it's trading at a significant discount, and I want to highlight this for you guys, and this is where we talk about bargain hunting. The group is now trading at a discount, a 60% discount. This is price NAV, but it's obviously it's a 60% discount to its group equity value of 24.74 Rand. Okay, that was compared to a 29% discount in early February. Imagine that's fallen much further now, and 15% discount 10 months ago. So this is what I believe is the opportunity. I meant to tell this right in the beginning. Please, my disclaimer, do not take this as a tip. There's not a recommendation. This is for education purposes only, this whole webinar. So please understand, this is not a tip. We're just highlighting for you how you use the research and things like that. So Old Mutual, we believe there's opportunity there. And as I say, go do your further investigation. If you look at this little, click on the little link here, it'll take you through to the 4-minute video on their results recently, and that's another tool for you. But what I highlighted when I read through this investment idea is that they're quite optimistic. These are our research analysts on Old Mutual in the sense that they're anticipating a pullback. We're trading around about 10 Rand at the moment. And we anticipate that the price will bounce back at least back to 1,739, around about 17 Rand level. You can see here from a technical point of view, and this is another point you want to bring in. So on the one side, we've got the fundamentals, the other side, we've got the technicals. This shows you a graph. This is a 5-year graph. The prices come back. Well, not a 5-year graph because this is since the divorce. But you can anticipate at least a 70% will bounce back to those levels there. If you have a long-term view, again, the share price is oversold. You can see on the technicals here, and we're bouncing back nicely. Yeah. So quickly in summary, before I take any questions, human emotion, remember our first little section, our goal there is to be objective. So do your homework, be confident in your investment decisions. Okay, be confident in yourself, be confident in your knowledge and the skill as an investor. So yes, if you got those of you got time, go learn as much as you can about the market now. Learn about investing. Go on the internet. Go to Investopedia and that. Go learn about investing. What makes a successful investor? What are the things to look for? Point number 2, what is your investment strategy? Why is it important to have a strategy? Because it provides direction. But also it helps you as an investor to make more informed decisions. So that's why it's important. So those of you that are traders, some of you might have heard the expression before, plan the trade and trade the plan. So having a trading plan is important. It's the same thing here with investing. And then when it comes to being cautious, now being cautious is an emotional word. So I like to drop it right now and say rather be careful. Okay, be careful is an action. So do your homework, okay? Be careful, can make you more confident. So always do your research, but be careful, especially in this market right now. Okay, so guys, let me just quickly see what kind of questions you have. There's a question, okay, let me see, yeah. Wow. Robert, you said you're only seeing the first slide. I don't know. Yeah. Okay, who else is seeing it? But I'll send you the presentation, okay? Yeah, Charles, yes, Jim is the host of Mad Money, okay? Jim Cramer, yeah, he does also the TV personality. Cool, okay. Gavin, good question. Are the big companies the ones that should have a good balance sheet to allow buyers to buy the sell and cheap? Yeah, so you might have heard of the expression before, blue chip shares. These are companies been around for a long time, good management, things like that, have historical record. So, but even those companies can have bad balance sheets. So you want to look at the companies that have strong balance sheets, they don't have debt or they don't have excessive debt. There's various ratios that you could use. They talk about the current ratio and the quick ratio. There's the ratios you'd use to calculate the short-term debt obligations and things like that. But to answer your question, yes, it will be mainly the big blue chip shares, the big companies that will be having the good balance sheets. So yeah, a lot of the small companies, anything outside of the top 100 or anything out of the top 40 be the blue chip or the large caps. Then we have the mid caps, which is the next 60 companies. Anything outside that is what we call the small caps. I think a lot of those small caps might not be around in the future. Those companies that have strong balance sheets will be resilient and will be bouncing back. Okay. Okay, vessel is trading considered to be when you sell shares within 3 years? Yes, because remember the receiver asked you what's your objective, was it income or capital? If you sell a share within 3 years, they'll consider that as income tax. So yeah, remember dividend tax is taken off already. Okay. Yes, Chapo, this will be recorded and I'll be seeing it out a bit later. What's the cheapest way to access the market at the moment? Mark, I'm not 100% sure when you say the cheapest way. Obviously, a share trading account is one way to access the market. I'm not 100% sure what you mean by that. What's the cheapest way? Okay. Any other shares? Kim, I can't really give you any recommendations. As I say, that I'm not a financial advisor. This is mainly for academic reason, for education. But do your homework. Go back onto that research thing. I've only highlighted one share out of that list of 10 that are undervalued quality stocks. There's 9 other companies you can look at, Kim. Okay. How do you evaluate the strength of a company's management team? Good question, Emil. That's what we call a soft analysis. Basically, you have to look at a few financial reports going back a few years. Hopefully, the management team hasn't chopped and changed too often. But also, you can look at their past decisions. You know, we've seen recently what's happened with Sasol, some of their decisions regarding Lake Charles and all those kind of things. So, you know, I hope that answers your question. That's a bit more of a soft analysis, it's a bit more qualitative. So if you look at a company that's been around for a long time, look at their management. How long has the management team been in place? And then obviously the share performance also dictates what's happening here. Charles Jabir is asking a question, what happened to oil Sasol? It was a whole things happening there. First of all, obviously the oil price dropped big time because of the big fallout between Saudi Arabia and Russia regarding, remember the OPEC members, they wanted to cut production, and next minute they flooded the market, and we saw what happened. The oil price dropped. I think to a large extent, they also wanted to get rid of the shale gas operators in the US. They've dropped below their cost values, so these guys are under a lot of pressure. I think that's also one of the reasons why Sasol's fallen. Sasol, remember, it fell big time because of what happened. They got a lot of debt they took on when the share price was over 300 Rand a share. When the share price dropped now, these guys were under a lot of pressure because remember they got debt. They have to still service that debt. So they're in the process now of having a rights issue. They might have to be selling some of the businesses and things like that. So, Charles, I hope that answers your question. Okay. Okay, Ethan, I mentioned dividends. I don't know which companies will pay dividends. Most companies will pay dividends. What you do is, the company will pay usually interim the first 6 months. Remember, they pay dividends out of profits, first of all, and that's number one. Number two is they will only declare dividend from the directors. So you as a shareholder will have access to that portion of profits as dividends. So you usually pay twice a year, interims and finals. But the best thing to do is to go onto the website again. Under that recommendations, there's a list of the top 10 highest dividend-paying companies. By the way, Old Mutual has a 10.9% dividend yield. So another reason why I like Old Mutual, because of the high dividend yield. Okay. So yeah, companies that will be resilient, will want to keep the shareholders happy, won't be paying out dividends. Ethan, so I hope that answers your question. Okay, Mark, come back to regarding the cheapest from the cost point of view. Good question. So yeah, if you open up a share trading account of PSG Wealth, the costs, just having a share trading account of PSG Wealth, there's a monthly admin fee of 60 Rand. So that's a cost of having a share trading account. Obviously, there's other ways. If you want to be more passive, you can open up a unit trust account with us, what we call a voluntary investment plan. The costs there are very, very negligible. From an admin point of view, admin cost point of view, we're talking about 0.3% per year if you buy into any of the PSG funds. So there's various ways of having access to the market. A lot of people want to get involved in ETFs. One of the best ways to get involved in ETFs, exchange traded funds, is through a share trading account, and then buying it on the share trading platform there. We don't have a minimum investment regarding getting involved in the market on the share trading side, but you must take in consideration the costs. You know, our minimum brokerage fee is 98 Rand per trade. Works on a sliding scale, but it's a minimum of 98 Rand per trade. If you invest 1,000 Rand, you must understand that your share must move up 9.8% to break even on costs. So it also depends on your timing. If you buy the share at the top of the market, it's going to take you much longer, and obviously to recuperate those kind of costs. Ideally, you want to be investing in 10,000 Rand at a time. Your cost is only 1% then. Okay, so Mark, I hope that answers your question regarding the costs. Price NAV formula, Rainier. NAV is just a net asset value of a company. Take all its assets minus all liabilities divided by the shares in issue. We have what they call a net asset value. A company should hardly ever trade below that value. If it does, like Old Mutual is, and there's a lot of other companies, those are companies are trading at a discount. So I hope that answers your question. But Rainier, go into the website, scroll right down before logging in, scroll right down to the bottom of the page. You'll find under support, there's a link to tutorials. And then through the tutorials, you learn a lot about fundamentals and a lot of the financial ratios there. Okay. If that doesn't help you, just come back to me regarding, I'll send you the link. Okay. Stephen, pleasure. Awesome. Thanks, Mark. Okay, guys, so it looks like that's all the questions. So just quickly before I wrap us up, obviously the questions have been quite a few. Thanks for the questions. So in conclusion, okay, those of you that haven't got a share trading account with PSG Wealth yet, just go into you can click on the link here to take you through to the registration process. Go register. Go do the whole freaker process. Once the account is opened, the next step obviously is to fund the account. The next step is to trade. Before you trade, I suggest you do your homework. Use the research tools available on our website. Under fundamental recommendations, there's filters. You can look at the different sectors. Use the search function to find out undervalued companies, but also use the company analysis, the investment ideas to make more informed decisions. Those of you who are the traders, there's something I would really recommend is looking at Viewpoint. You can subscribe to that. If you click on Viewpoint today, it takes 24 hours, then you'll have access to it tomorrow. There's a subscription involved. It's 250 Rand a month with including that. But it's a technical analysis program. And if you subscribe to live prices, it's an amazing tool, especially if you're a serious trader. Okay, so it's a technical analysis charting program with live prices, as well as obviously a trading platform. You can trade directly from that. Okay, so those of you that are single stock futures traders, that's what I recommend you guys use. If you want to trade index futures, that's what I suggest you use. Okay, same as also with the CFD guys. Okay, so this webinar, the recording of this webinar and the presentation will be sent out soon. So from my side, bottom line, the whole idea about this presentation was be confident in yourself, do your homework, be confident in your analysis, and be confident in your portfolio. and that was going to help you take you forward. So from my side, happy investing and good luck. And again, there's my contact details. If you guys want to get all of us, you can send an email to wealth@psg.co.za. You'll also contact us through 0860 000 368. So lastly, just to end off, just again, disclaimer, please do not take anything in this presentation as any sort of recommendation for a share. It's just for you, education purposes, do your homework, and things like that. Okay.